Hello everyone, welcome to the third session of Cambridge Connect's peer-to-peer conversation. Today we're going to have another very interesting and practical topic on legal issues that all investors and founders should be looking at when they are analyzing deals and see the potential of their own company. So welcome to this session. We have the privilege of having Josefina Yabar, who's going to be our guest today, and she's going to walk us through what's the role of the LP, the GP, and so forth. So all the questions that you have, please remember, try to capture them in the chat box. Steve Lyle, who's here today also, is going to be in charge of reading them out loud at the end of the session. But please, this is a conversation, so it's very important to clarify whatever the doubt you have in all the areas. Josefina, can we move to the other slide, please? So remember, please, the microphones should be off. Capture all the questions. They are more than welcome. I'm going to be your host today, as in the previous sessions. I'm the Cambridge Business Association Director for Latin America, and I'm also part of Oxbridge Capital Partners, which is the venture capital firm created between Oxford and Cambridge with different investors from these major universities. This is the agenda for today. I already gave you a brief, but it's very important to get to understand what's the tax issues, the due diligence process, how to deal with shareholders, the term sheet, what are the key metrics that we should consider, and all the variables that are relevant for you as a founder or as an investor. And of course, see all the financial schemes that are available, the most common ones that can be of value to your own reality. Before we get started, I also like to acknowledge all the strategic partners we got, especially E-Class, which is the platform, the training platform for managers in LATAM to create specific classes in different subjects that are critical to be updated in different knowledges. Renaissance Executive Forum, which is the place to talk with CEOs and founders to learn, grow, and share in a trust environment, so you can learn from other people's experience and implement it in your own reality. Hacienda Santa Martina, which is a nature club that are all the community for CBA are invited to join, is the best place to go with the family and relax, and of course do business if you want to do so. And today we have the privilege of having Jasreen, one of the leaders of Oxbridge Angels, who are helping us out to do all the creations from different startups that we are looking at today. This is the faculty. You already know them, so I won't be introducing each one of them in today's session, but if you have any questions, please do reach out to them and ask specific questions via LinkedIn, here in the chat box, and so forth. Let's get started. So let's dive into the content that brought us here today. Josefina, welcome to the session. Thank you so much for your time, and we are eager to learn from your experience and all the knowledge you have to share.
Thank you, Guillermo. Hi, everyone. Very glad to be sharing this conversation with you today. As Guillermo introduced you, today we'll be talking about main legal and tax issues around venture capital financing. So just to put ourselves into context, here you can see the classic diagram describing the life and different stages in the life of a startup. You have the seed capital, early stage, later stage, and then you have the more mature company in the IPO and public market stage. And in each stage, you can find the different financing sources that when the startups gets the funds for each of its stages. As you may see, when the startup is in the seed capital stage, the startup needs the necessary funds to start operations, to start the business, and here the funds are obtained through more informal sources. Here you have the classic 3 Fs, which are the family, friends, and someone says the fools, that believes heavily in the entrepreneurs. And also you have some investor angels that gives financing to the startup in this stage. Then when the business is more than just one idea, when the business model starts operation and the startups penetrates the market and needs to penetrate more heavily markets in other jurisdictions, more funds are required. And here you are in early and later stage. And here is when venture capital funds provides financing for the startups in these stages. And later on, when the company is more mature, you have more traditional ways of financing. The company probably goes public or have access to private equity or more traditional financing sources. So our conversation today will be focused on the green part of this diagram, which means that when the company is in its early and later stages of financing, and when the funds are provided by venture capitals, which are usually incorporated or formed as investment funds. So to start, I would like to highlight the main characteristics of venture capital financing. The first and the foremost characteristic, of course, is risk. As we saw in the diagram, the investment here is in early stages of the company. So there is uncertainty as of how the business is going to be successful or if it's going to fail. So there is uncertainty on how this investment is going to go through. And in order to balance or equilibrate that risk that the investor is going through by investing in these companies, the investors look for a high growth potential company in order to ensure that profitability is going to be in some way certain in some point in the future of these companies. Also, to equilibrate and to balance the risk that the investor is assuming in this type of financing, investors need to diversify, of course. Venture capitals are always investing in large number of companies because, as you may know, 1 or 2 out of 10 of these type of companies are actually successful and actually gives a return to the investors. So they are always looking to invest in many type of companies. Also, venture capital investors are not passive investors. Here, the concept of smart money is a very typical concept in this industry. The venture capital investors will not only provide funds to the company, but they will also provide knowledge, network. They will be constantly monitoring the business, and it is also a way for them to protect their money invested, as they will want to be in knowledge of what is going on in the company, and it's a way, of course, to protect what they have invested in the company. And also, this type of financing, different from what we know as a traditional type of financing, there is no guarantees. Meaning that we do not have pledges, mortgages, you do not have joint and several guarantees from the founders because founders do not have money, they are not tangible assets that can be pledged or mortgaged. So there are not guarantees in a traditional sense, but of course, as we are going to talk later on, the investor will protect its investment through other type of guarantees, which are some contractual provisions or rights of preference that will in some way protect the investment that they are doing in this type of companies. So let's get through on how the investment process is structured. Mainly, we can see that an investment process by a venture capital consists in 4 main stages. First, you have the deal screening. This stage is not strictly legal. Each fund has its own screening, sourcing, scouting process. You may see that some funds have investment committees that are always searching, evaluating different deals. So I will not focus a lot on this stage as it is not strictly legal, and every fund fund has its own screening process. Once a startup company is selected to be invested in, the next major step in the process will be the execution of a term sheet, LOI, memorandum of understanding, whatever you may call it. But this is like the preliminary document that will set forth the main terms of the transaction. Once you have your term sheet executed, you will start, the fund will start a due diligence process. Due diligence may be, I will focus on the legal due diligence, but you will also need to run a commercial and a financial due diligence, of course, of the company. And then once you have done the due diligence and the due diligence is successful, meaning that you, the investor didn't find any major contingency that would prevent the fund from investing in the company, then you'll have the closing, which means that you will negotiate, agree, and execute the final documents where the transactions will be, the investment will be materialized. So I will get through each of these stages, except for the deal screening. As I said, that is not a strictly legal stage, and that every fund has its own screening process. So let's go through the term sheet. The term sheet is a legal document. It's maybe the first major step in the transactions where the material terms of the deals are negotiated and agreed to. It is a very useful document for lawyers because it gives us a good roadmap on how to draft the actual and definitive documents for the deal. And very important to highlight that usually this is a not binding agreement to fund. The transaction will be usually subject to agreeing to the final documents. You can also subject the transaction to running a successful due diligence, or maybe you will need to put in place other conditions. In Chile, for example, it's very typical for those funds that are financed by Corfo, which is a governmental agency. You will always put a condition there that the funding will be subject to Corfo approval, for example. So it's a non-binding agreement, but you will, of course, see two major binding provisions which are actually binding, and it's very important for these provisions to be binding. The first one is confidentiality. You have to bear in mind that once you sign and execute this term sheet, you as an entrepreneur will open your company to the investor. You will share all of your information, your business model, your legal information, your commercials, your financials, and of course you will want to be protected that information that you are sharing is kept confidential by the investors and by every people reviewing those documents. So even if you do not have a term sheet in place, or even if you want to just go and negotiate the final documents, I will always strongly suggest that at least you have a non-disclosure agreement or a confidentiality agreement in place if you want to open your company to a due diligence process. And the other binding provision that you will find in a term sheet is the exclusivity provision, which means that for a certain period, it may be 30, 60 days, the founders, the company agrees to prevent them for selling or issuing any shares of the company to a third party different from the investor that you are negotiating with. If you are negotiating, you are raising a round with more than one investor, of course you will not have this clause in place, but if you are negotiating with just an investor, and the investor will probably require to include in your term sheet this exclusivity provision. Term sheets do not have like a typical content. We will go through like the main sections that you will find in a term sheet, but you can see 1-page term sheets or 10 pages term sheets. Of course, as more details you get into the term sheets, the better. But on the other side, you will not want to spend 3 months negotiating your term sheet. So it's a document that you need. It's very useful to have it, principally because of the confidentiality, because of setting forth the main terms of your transaction. But this is a document that you need to sign as quickly as possible in order to get the funds in a faster way, of course. So as I said, even though we do not have like a typical content of a term sheet, here I have highlighted the main sections and clauses that you may find or you may want to include in a term sheet. The first section, of course, is the commercial terms and conditions of the offer. Here you will include the amount of the round that the company is raising, and within that round, what the amount is going to be invested by the investor executing that term sheet. What type of shares will be given to the investor. Usually those shares are going to be preferred shares, as we will see later on. What is the valuation given to the company on this financing round? What type of deal are you going to execute? Is it going to be an equity deal? Is it going to be a convertible note deal? When do you expect to have the closing of this round? Usually you will have 30 days, 60, no more than 90 days. Usually founders are eager to receive the money as soon as possible. So everything here is done very fast. The conditions for closing, as I said earlier, this can be, of course, the execution of the final documents, due diligence, governmental authorizations if the funds is financed by a governmental agency. Whether the company will need to have in place a stock option pool. It's very important to have it in place before the investor enters into the company. Usually stock options pools go around 10% of the company. And other provisions such as vesting of the founders' shares in order to keep them keen in the game on their business. This is like the first section of the term sheet, which highlights the terms and conditions of the offer. And of course, a very important section of your term sheet would be all the rights and preferences that will be given to the preferred shares that the investor will acquire. And here I have listed like the typical preferences that you may find or you may negotiate in this type of deals. We'll see these preferences in more detail when I will talk about the actual documents, but you will see liquidation preferences for the fund in a sales or liquidation event to be paid with preference to the common stock. The board composition, if the board will be comprised by 3 members, 5 members, the venture capital will always want to have a board seat or at least an observer or representative of the venture capital to be present in the board's meetings. Protective provisions, meaning veto rights, transfer of shares, information rights. All of these we're going to talk in more detail in a few minutes. Also, you will want to include in your term sheet the due diligence regulation, the time frame within the due diligence is going to take place, who will handle or who will bear the expenses of the due diligence. Usually these expenses are shared between the founders and the investors, and the confidentiality and exclusivity provisions that I talked earlier. And of course, the miscellaneous clause that there you have governing law, jurisdiction, etc. These are like the main clauses or provisions that you will find in a term sheet, but as I said, this is a very dynamic document, and no term sheet is similar to other term sheets that you may find they're very deal-specific documents. So once you have your term sheet in place, you have executed, you have agreed to these material terms of your deal, Then the second stage on this investment process will be starting the due diligence. I will focus here in the legal due diligence that an investor runs through. The due diligence, it means a review and assessments of the legal situation of the target company with three purposes. The first purpose, of course, is to obtain that information that enables the investment decision. Once the due diligence is conducted, the investor may decide whether or not to invest in the company. And that is why you subject your term sheet to due diligence, and that is why your term sheet is not binding, because if you find a huge contingency during the due diligence process, you, as an investor, will have the ability to walk away of this deal. This is like the main purpose of doing the due diligence. Another purpose of making this due diligence is to determine valuation or confirm the valuation that you assign to the company in the term sheet. If you find, of course, a huge contingency, a huge liability in the company, maybe the company is worth less, and the valuation that you agreed to in the term sheet may be to be revisited or even renegotiated after the due diligence process and in the final documents. And also, due diligence allows you to identify contingencies. Some contingencies can be resolved or remedied before closing. For example, in Chile, it's very classic to find that the intellectual property of the company is registered under the name of the founders and not under the name of the company. This is because it's easier to register and it's faster to register the IP under the name of the founder. Maybe the company, sometimes the company is not even incorporated. So this is a typical contingency that you find. And of course, the investor wants that all the intellectual property of the business is allocated in the company. So, but the transfer of the IP, at least in Chile, is a very easy process. So this is a type of contingency that it's important for the investor, but that can be easily resolved before executing the final documents. Other contingencies that will take a lot more time to resolve, but that they can be remedied, in fact, can be established in the investment documents as a post-closing obligation to be done within a time frame after the documents are actually executed. And other contingencies that cannot be solved. For example, you find a huge a debt in the company, or it has litigation the company has been sued for a huge amount. Those contingencies are not able to be solved. Those contingencies will impact, of course, in the valuation of the company, and maybe you will want, as an investor, to renegotiate the valuation that you assign to the company in the term sheet. So these are the three main purposes why it's important to run a due diligence process here. How do you plan your due diligence process, or how do you run this due diligence, legal due diligence process? First, the investor will prepare a due diligence request list and will provide that list to the founders, to the company, in order to prepare the necessary information that needs to be reviewed. And here you will need to review all the legal aspects of the company. You will ask for the incorporation documents in order to secure that the company is well incorporated. You will ask for the corporate books and records of the company in order to check that everything is according to applicable law and everything is in place. Of course, you will ask for the financials of the company, very important, in order to assess that it's a healthy company. Employee materials, it's very important to assess whether all the workers or the employees have employment agreements in place, that the company has complied with all the employees' obligations. You will want to review the main material contracts of the company, the main contracts with the clients, with their suppliers. You will want to check whether there are other contingent liabilities, whether there are other, for example, convertible notes, or whether there are some debts with banks, or even sometimes the founders lend money to the company. So you will want to check whether the company has any other liabilities. Litigation, of course, is a very important issue here, to know whether the company has any litigation in place or threatened against the company. You will want to check, of course, the assets of the company. It's in this world, it's very difficult to find startups with tangible assets, but if they have, you will want to check if those assets are under the ownership of the company, and the titles for these assets are good and valid. And the main assets here, and what you really review, is the intellectual property of the company, whether it is registered under the name of the company, whether there are patent softwares that needs to be registered, and that all the IP of the company is effectively under the ownership of the company and not under the ownership of any third party. Those are like the main aspects of the life of the company that you will include in your due diligence request list. And once the founders receive this list, they will prepare a data room. Usually this will be a virtual data room, where the company will be uploading all the documents that were requested by the legal team of the investor. Then you will have a Q&A sessions, which I highly recommend to have, and are very useful to have these sessions with the founders, with the main executives of the company. They are very useful in order to speed up the process, to understand the business, and to address the issues and resolve the pending information that you may find. And once you have all your documents, you have review, you have your Q&A sessions, the deliverable that the lawyer will give the investor is a due diligence report, usually under a format of a red flags report, in which the legal team will highlight the main contingencies found, the course of actions to be taken upon each of these contingencies found, whether they can be remedied or not, and the level of risk assigned to each of these contingencies, whether they should prevent the investor to invest, or whether these contingencies may be somehow addressed in the transaction documents. So this is how our due diligence goes. We have our report, the due diligence is finished, and then we go to the closing stage, where you negotiate the final transaction documents. So we will get through this. There are two main types of financing deals in venture capital, which is equity deals and convertible notes deals. These are like the two types of financing deals that are very industry specific. You can find, of course, other type of structures. You can find traditional debt. You can find a cash out, direct sale and purchase, shares from the founders. But the characteristics type of deals of this industry, in this industry, is an equity deal or a convertible note deal. So we will get through these both type of deals. Convertible notes. Convertible notes is debt, but it's a short-term debt. Usually you find convertible notes from 18 to 24 months at the most. You also agree to an interest rate. But the difference here with traditional debt is that this debt, upon the occurrence of certain events, it converts into equity, which means that the investor becomes a shareholder of the company by acquiring shares of the company, usually preferred shares. The most common conversion event is upon a qualified financing, which means that the company raises a financing round of a certain amount, and once this means that the company is doing well, of course, and the note holders in that same round convert their debt into equity and acquire shares, preferred shares of this same round. But also you can find, or you can agree to, other conversion events. Other conversion event may be a sale or liquidation event, which means that if, for example, the company enters into a merger process or a corporate reorganization process where at least 50% of the shares are exchanged for other shares, or maybe the company is all the company or substantially all the company assets are acquired by a third party, or the majority of the shares are acquired by a third party, or the company goes public and launch an IPO, or those events are considered sales or liquidation events, and these events will trigger the conversion of the debt. Usually, this conversion will be into ordinary shares in order to allow the investor to get the upside of this liquidation event, or the investor may elect not to convert, but to receive a preferred payment, which means to be paid a multiple 1x or 2x the original investment amount. Other conversion events that you may establish is the certain milestones achievement of the company that also reveals that the company is doing well. Maybe the company does not need to raise a financing round, but has achieved certain milestones that are agreed to in the note. For example, closing a certain number of contracts with clients, achievement of a certain sales margin, or the achievement of certain financial ratios. All of this reveals that the company is doing well and will allow the investor to convert its debt into equity and acquire preferred shares in the company. There are two main protective provisions for the investors that you will usually find in convertible notes, which are the cap and the discount rates, and are protective provisions because the investors are protecting the investors that invested in early stage of the company where the risk was higher than compared to investors that invested in the equity round that the company raised later on. The cap, or the maximum cap, is the maximum valuation of the company to which the investor will convert the note. So if in the financing round that triggered the conversion of the note, the round valuated the company higher than this cap that was negotiated in the note, then the price per share of the note holder will be calculated on the basis of the cap, and not on the basis of the valuation assigned to the company in the financing round, and therefore the investors, the note holders, will get more shares than if this cap was not in place. And if the financing round valuates the company lower than the cap that was negotiated in the note, then the discount rate will apply, which is a percentage of discount from the share price set forth in the round. It's a direct discount on this share price assigned in the round. Usually you will find discount rates from 10 to 20%. That is like the market standard discount rate. So when do you use, or why you will use convertible notes as opposed to an equity or an equity financing? You will usually find convertible notes in the seed stage of the companies, Why? Because in that stage, maybe you do not have the sufficient elements to evaluate the company. You do not have, the company maybe does not have any clients, any sales, so it's very difficult to assess an exact and concrete valuation of the company. So it's preferable to invest through a convertible note and defer the valuation of the companies to a later stage when you have those elements in place. Another reason to use convertible notes is that it's a faster and cheaper way to get funds. Why? Because you only need to negotiate the one document, which is the convertible note, and it's a very standard document. You do not need to heavily negotiate the preferences. You just need to agree on the amount that is going to be invested and the valuation, the cap and the discount rate. But you do not have too many issues open that needs to be negotiated. So it's a document that you can execute really fast. And also on the side of the founders, it's more beneficial because the investors do not have control on the rights of the company. So investors at this stage are not shareholders, are not holders, so they do not have right to vote. They do not have economic rights on the companies. They're just another, and then it allows the founders to retain the control of their company during this stage. The other type of deal in venture capital that you find is equity. Equity means that the investors make a capital contribution in the company, and the investor acquires preferred stock of the company because of that capital contribution that the investor made in the company. As the investor acquires shares, the investor is a shareholder of the company from day one. So the investor has control rights and will negotiate control rights from day one. It will have a board seat. It will have right to get dividends, right to get the capital back if it's agreed to, some voting control, protective provisions, veto rights. The investors will negotiate all of these as shareholder of the company. You use equity as opposed to convertible notes when you have certainty of the company valuation, because here you need to assess what percentage of the company will be given to the investor, considering the amount of the investment that is contributed to the company. So you will find equity investments in later stages of the company's life. And equity and investment in equity has higher transaction costs. Why is that? Because here, as opposed to convertible notes, where you have to negotiate only one document, here you have to negotiate more documents. You will need to negotiate the shareholders' resolution approving the capital contribution and the issuance of the preferred stock. You will have to negotiate the stock purchase agreement, representations and warranties, indemnities in that stock purchase agreement. And also, the most important document here that is heavily negotiated is the shareholders agreement. And I will stop here in this document, which is very important, because it's like the agreement and the contract that among the shareholders of the company that will regulate the relationship as shareholders of that company. And here you will find and negotiate all the rights in favor of these preferred shareholders. So this is like the document that is heavily negotiated in these equity rounds. And what are these preferences that I highlighted in some way when I talked to you about the term sheet? The most common preferences that you will find in shareholders agreement and that VC investors will want to have in place are, first one is the liquidation preference. The liquidation preferences applies when a liquidation event occurs in the company, meaning an M&A, a corporate reorganization, a sale of the company, or a sale of the assets of the company. And once that liquidation event occurs, when the distribution of those liquidation proceeds occur, the preferred shares will have the right to get a certain amount of money back before the common shares get anything. So here the investors is securing the return on their investment once a liquidation event occurs, with preference to the common stock. Sometimes even some multiples are used. The investor will negotiate not only having back the original investment amount, but 2 times the investment amount, or 1.5 times the invested amount. The other preference, the very common preference that a venture capital investor will negotiate here is a board seat. This is very important for a venture capital because, as I said in the beginning, the investment of a venture capital is not a passive investment, and it's a way, of course, of protecting the investment and balancing the risk of the investment here. So the venture capital will want to have the right to appoint a board member in order for that board member to be informed and to be informed of how the business is going, and to have something to say when it sees that something is going wrong. Usually the venture capital appoints experienced people experience in venture capital business. So this is seen from in my experience from the founder side as very positive thing to have these people seated in your board. Usually the board seat is negotiated when the preferred shares are, the outstanding preferred shares are 5% or 10% of the issued shares. If the preferred shares represent a lower percentage of the issued shares, usually the investor will not have the right to appoint a board member, but the investor will want to keep the right to at least appoint an observer, which is a representative of the venture capital that will have the right to assist to the board meetings with the right to speak, but with no right to vote. So it's a way to keep the investor informed of what is going on in the business and in the operations of the companies. Also, you will have protective provisions, which essentially are veto rights at the level of the board resolutions and at the level of the shareholders resolutions. Here, the preferred shares will have veto regarding a list of resolutions that the company is not allowed to adopt without the consent of the investors at the shareholders level and at the board of directors level. This list of veto rights is a heavily negotiated list, and here you will find, I don't know, the approval of the business plan, for example, the issuance of a stock option pool, the designation or appointment of the CEO and the main executive of the company, and the determination of the compensation of those executives, the disposal of assets, especially the disposal of the intellectual property of the company, all the major corporate acts, bylaws amendments, decrease of capital, changing the number of the board, the resolution regarding that the loans that the company may make to third party. Of course, it's something that the investors will have something to say. To grant guarantees to third party, to guarantee obligations of third party, and so on. So there is this list, as I said, is heavily negotiated, but it's something that you will always see in place in a shareholder agreement of this type. Then you will have also restriction on the transfer of shares, the typical right of first refusal, tag along, drag along. In the right of first refusal, the investor will want that if the founder receive an offer to sell its shares in the company, of course, investors do not want that the founders have a free way out of the company. The founders are the key elements here. So the founders will have the obligation to offer those rights first to the company and then to the investors or the major investors of the company. So for them to have the right, I don't know, to find another founder or to do something with that shares. But of course, the investors will not want that the founders have an easy way out or to have a third party in the company because the founders need some cash. Okay. The tag along right, it's important for investors to be included in the sales of if the founders receive an offer to buy the shares. If the investors do not want to buy those shares, they can sell those shares along with the founders. And drag along, meaning that if the company receives an offer to be acquired in more than 50%, for example, the founders, also all of the shareholders are somehow obligated to sell. But here, the caveat here on the additional protection for the investors in drag along is that they will set a minimum price of this offer to buy the company at which they will be obligated to sell. So in this way, they assure that at least they get the return on their investment in this scenario. And of course, information rights, very important, as I have said. Here it's smart money. Investors will need to be informed of what is going on with the company. And usually investors will require here to get access to audited financial statements, the annual financial statements, to quarterly unaudited financial statements, and will require to have access to a monthly report of the operation of the income, the cash flow of the company, so as they have a good sense of what is going on in the company. These are like the main preferences and the main clauses that are heavily negotiated in a shareholders agreement, and that is why I said before that an equity type of deal has high transaction costs, because there is much more to negotiate than compared to convertible notes that usually do not get into these details in a convertible note. It is very more straightforward document here. This is how I have talked of how you structure a venture capital deal. And I will want to share with you some thoughts on what benefits you can find, at least in Chile, of incorporating a VC fund here in Chile. And there are two main benefits of having your fund, your VC fund in Chile. On the one side, you have a financing leverage. Here in Chile, we have Corfo. Maybe you have heard about this. Corfo is a governmental agency in Chile, which is dependent of the Ministry of Economy, and is in charge of promoting venture capital, promoting innovation, technology, entrepreneurship, and competitiveness in our country. And it has been a key player in the development of the venture capital industry here in Chile. Corfo has in place certain programs and regulations to seek to promote venture capital as an investment mechanism in which, together with financial resources, the venture receives the support of a strategic partner that allows the accelerating the development and the growth process of the company. And how do these programs look like for private funds established, incorporated in Chile, which has the purpose to finance Chilean early stage companies with growth potential and innovation. Corfo has in place great facilities, leveraging the fund's private capital up to between 100% and 300%, depending on the program, which means that if the limited partners of the funds contribute one to the fund and has this program in place with Corfo, Corfo will open a credit facility allowing that fund to borrow up to 3 or 2 depending on the program. It's 100% to 100% or 300% depending on the program, but it is a very good way of enlarging your fund and giving and having access to a financing source of your fund, and will allow that fund to invest in more companies and to invest in larger rounds or in later stages of those companies. And a key characteristic of this type of financing by Corfo is that there is no obligation to repay Corfo's loan. If once the fund is liquidated and there aren't enough funds to repay Corfo loans, there is no obligation to repay Corfo's loan. So it's a very, as you may see, it's a very, very attractive financing tool that we have in place, and it's available for private funds incorporated in Chile. And also there are some tax leverages here for funds in Chile. On the one side, listed funds incorporated in Chile are not considered income taxpayers, and therefore all the profits obtained are not subject to taxes at the fund level. So if the fund invests in a company, the company will pay the corporate tax at the company level, and that profits that are distributed to the fund at the fund's level, once they are distributed, the funds does not have to pay any income tax, which is like huge benefit here in Chile for funds. Listed funds have their benefits just for being listed funds. For private funds, you have the same benefits, meaning that private funds are not considered income taxpayers, and profits obtained are not subject to taxes at the fund level. But for private funds, have to comply with 2 requisites, which are that the company that it's managing the fund or its related persons is not allowed to have more than 20% of the stake of the fund, and the fund must have at least 8 limited partners, but none of them together with the related parties should have more than 20% of the bank fund. So you have to have at least 8 LPs with not more than 20% each of the stake of the fund. Or you can have only one or more institutional investors having at least 50% of the fund to get this corporate, this tax benefit. Who are institutional investors? Institutional investors are banks, insurance company, the fund managers acting on behalf of a listed fund, and foreign also a recent regulation here allowed foreign investment funds which are under the surveillance of a public or governmental agency such as the ACC or our CMF are considered institutional investors. So here you can have very interesting structures, because if you have like a foreign fund incorporated abroad that is under the surveillance, is a listed fund, meaning that it's under the surveillance of a governmental agency, a governmental public authority in their country of incorporation, that fund may incorporate a private fund, for example, in Chile, and that fund in Chile will benefit from the financing benefits that we saw of Corfo financing programs, and also will benefit from this tax benefit that the fund will not be considered taxpayer for income tax purposes at the fund level. So here you can create very interesting structures in order to benefit directly from these leverages that I have explained. Also, other tax benefits that we have in place are that profits distributed by a listed fund to a foreign limited party, meaning that you have a listed fund in Chile and that fund has foreign limited parties, that profit distribution is subject to a reduced 10% withholding tax, but without the right to deduct the corporate tax paid by the operative company at the company's level. Usually our withholding tax is 35%. So here the fund is benefited to a reduced withholding tax rate, but without the right to deduct as a credit the corporate tax paid by the operating company. The corporate tax of the companies here in Chile is from 25 to 27%. Just for you to have that in mind. On the other side, the profits that are distributed by private funds to foreign limited partners are subject to the standard 35% withholding tax, but here you have the right to deduct the 25% corporate tax paid at the company's level. Repatriation of capital is not taxable, provided that there aren't any financial or taxable profits at the fund level, which is another benefit. And another important benefit is that you can have a listed or a private fund incorporated in Chile, but if 80% or more of its capital is invested in foreign assets, meaning foreign shares of foreign companies, for example, profits are considered as foreign income, so it will be tax-free in Chile. So here is another interesting structure. So because you can incorporate your fund here in Chile, benefit from, I don't know, Corfo financing, but you can invest 80% of the capital of that fund abroad in foreign startups, in foreign companies, and those profits will not be subject to tax in Chile, which is another benefit of tax benefits. And I think I have talked too much. So happy to discuss, to hear your thoughts. I know legal stuff is very hard to process, but happy to listen to what you have.
Sure.
Your questions
We
are.
do have a lot of questions. Actually, Steve is in charge of replying while you were talking, because there are a lot of in the parking lot, a lot of questions in the parking lot. So this got a lot of traction. Steve, would you like to read some of them out loud so Josefina can help?
Well, yeah, I think what I'd like to do, because some of them were, a lot of them were softball questions for me that Josefina, no problem. But I thought one of the more interesting ones that I think Josefina has a really unique perspective on from her position is the standardization of like Y Combinator safe docs, or generally speaking, just, docs that you see coming out of Y Combinator, such as a convertible note, convertible note agreement, something like that. Now, my experience has been, and it's still my experience is still kind of new with Latin America, is that I just saw recently a deal in Argentina. It was convertible note. Use exact same convertible note doc that we use in Silicon Valley. Exact same.
Yes.
I mean, verbatim, exact same words except for legal venue and stuff like that, right? Is that venue? And of course, I said in the chat, make sure you consult with your local regional legal advisor on this, because there are nuances. But what's been your experience in terms of like standardization? It's Y Combinator docs that they're getting in.
Yes. Well, this the legal industry here, or the legal advice in venture capital, is always looking the US, the UK, and we. Even though we are a civil law country, so we have structured categories, and we do not have many, we are bounded by laws and regulation that regulates the contracts that we are allowed to execute here in Chile, but we are always looking at what you guys in the US are doing there. So it's kind of a mixture here, because we have imported and are always looking there, and we use your documents, US documents, the UK documents, we use them, but we have to localize that documents, right, in order to categorize them in a civil law category, so as that document needs to be valid and binding in Chile. So, for example, convertible notes are acceptable here in Chile because they are debt and you have an interest rate and you have a maturity date. But for example, safes, I have my doubts. You see safes executed in Chile, but I personally do not like safes because you fall into that problem that you cannot categorize that into any of our contract categories that we have and that are binding for us. Here in Chile, you have debt, you need to have an interest rate, and you need to have a maturity date, all of which you do not find in a safe. Safe is something that you cannot categorize here in Chile. So I would not suggest to execute a safe here in Chile because of that, because you may have problems with our IRS because of you do not have interest rate and maturity, and debt here in Chile is subject to a stamp tax. So you may have problems with our IRS, so that is why I do not recommend them. But we have, as you said, we have sort of standardized our convertible notes, looking very much at what is being done in Silicon Valley and abroad. And yes, it looks like a convertible note that you will use, of course, in the US, but we need the maturity date, we need the interest that we need them in place. And we have, just as the Y Combinator did we have, as an industry, made an effort to standardize the documents. There is an association here in Chile, which is called the ACAFI, that make a huge effort in order to standardize and the legal documents on this industry. And if you go to their webpage, the same as the Y Combinator, you can download those notes and you will see that, as you say, they look like a note that you will execute in any other jurisdiction. So, but as I said, we are very limited on what we can do because we are a civil law country and we have those categories that we must respect.
Yeah, I should add, Josefina, that's a great point that you made on safes. A simple agreement for equity, typically that's in lieu of, we see them in service agreements. Like, let's say, a lot of times we'll retain like a legal counsel on a deal. We don't have the cash to pay if we're a startup. So the legal says, I'll tell you what, I'll work for food. Well, what's your food? I like to get some equity. Why don't we do a safe deal? If I do X amount of services, there will be billable hours and that will get me X amount of shares, right? And so it's exactly right. It's really not like a security instrument. If you're investing, you invest with a security instrument. That's debt or equity. You invest money, you get a debt instrument. You invest money or you get some stock, right? A safe agreement says you're getting something for something.
Yes.
It's not. It was never intended to be an investment vehicle. It should not be an investment vehicle. It's an accommodation to pay somebody in lieu of cash because you don't have the cash. And you'll see a few safe deals, right? And so it has a purpose in the marketplace, but it's not to make an investment. I'm so glad that you brought that up. One of the questions came up around how long it takes to do 6 to 8 weeks is normal. Somebody provided a little bit of a nuance, like with Corfo could add another, 4 to 6 weeks, but not months. Could you provide a little bit more insight? Once a VC says, we're done through due diligence, we want to give you the money, but Corfo is our syndicated partner, so we've got to wait on them. We're trying to work on a parallel path, with Corfo. Is early on, we say, hey, we're going to do this investment. It's in due diligence, but we'd like to do this investment. I think that's up to the VC to try to compress that timeline, working a parallel process with Corfo. So, it's not incremental where you had a 6 weeks due diligence process, and then you got like a 4 to 6 week process with Corfo after that. I think the VC should be more intelligent in how they're managing Corfo, because it's all about transparency, talking to them frequently and as early as possible in the process. Could you provide some more insights into that? And Rodrigo,
yes,
of course, has lots of experience.
A very good question. I have participated in a lot of US-based deals, and yes, when you put Corfo on the table, all the VCs get like, what is this? Why do we have to wait? How much is this contingent? What if it's going to happen if Corfo does not give the funds? I think yes, yes. But the thing is that I know that you start the due diligence process, and then you go to Corfo, but you cannot speed very much that process because Corfo requires you to get the approval once the documents are executed. So once the documents are executed, then you go to Corfo, and there is no much room whether to speed up the process and to get the Corfo approval while the due diligence is running through, because Corfo needs to see the final documents before getting the approval. But on the other side, Corfo is getting very short. Nowadays, I think that Corfo is speeding up their internal process in getting the approvals. So, and at least in my experience, it has never rejected a deal, or a deal has fallen apart because of Corfo. I know that this is like not a very VC style, and all the VCs get very frightened when Corfo is in the place, but you have to get the Corfo approval once the documents are executed. There is no other way to go around that.
Well, we're trying to go through, I think a parallel process really helps. Talk to them as early as possible in your due diligence, and maybe if you do talk to them early, Corfo could say, well, yes, we approve, this checks all the boxes. but your due diligence might say, oh, you know what, we changed our mind, so that's the game that you play, right? So it's this last question from Christopher is interesting. I did answer it, but it has to do with Corfo's requirement in terms of it's actually, this has to do with the tax-free provision, investing 80% abroad. And I answered it saying, listen, yeah, that's true, but remember, the objective of Corfo is to not send money away and see nothing come back. They want to drive business development and research and development, R&D in their own country. They want to drive jobs in their own country. So if you were investing in a foreign enterprise, it's not just about generating economic benefit to the foreign country, but to bring that benefit back in a very meaningful, tangible way. This is a very, very important thing. This is what Corfo is all about.
Yes, that's right. Corfo is like an agency that wants to promote investments and innovation here in Chile, and all regulation of Corfo goes around bringing back the money. If you invest, for example, if the company has a holding company in the US, and it allows you to invest directly in the foreign company, but you have to, within days, to bring back that money to the company that is incorporated in Chile and where the operations are run. That is like because Corfo's purpose is to foster innovation and entrepreneurship here in Chile. But recently, Corfo has amended its regulation and has allowing some funds to invest their money directly in foreign companies under some requisites that those funds needs to be funds owned by the private funds, not financed by Corfo, but they are allowed in some way with some requisites. But Corfo is understanding that the need for the funds to invest in foreign companies, because our country is very small, and maybe just investing here, it will not be profitable for the funds. And it has opened very, very recently the regulation in order to allow to invest directly in foreign companies. That is something very new, and we are very happy for this, because I think it's going to benefit a lot of our VC funds.
There's a great question. I'm from Santiago. Do all the funds need to come back to the subsidiary within days? I'll type my answer while you're talking, because I know that it's not like you need to turn it around right away. They're looking for a best efforts in some real tangible way. You're setting up an office, you're hiring maybe some engineers. These are things. It's part of your overall business plan, isn't that right?
Mm-hmm. Yes, you need to, as I said, you need to, it is allowed to invest in the foreign company, but you need to bring, I think it's within 7 days, the money into Chile, and you need to make a capital increase in the Chilean company, and Corfo will require you to prove that the funds were returned in some way back to Chile. That is the truth.
Okay. Looks like that's pretty much it. When we already used up our time, so back to you, Guillermo. Thanks a lot.
Yeah, I think we are about on time. So it's very important that we answer all these questions. If you have more, please do send them to the email that we have been sharing before, cba@cjbs.net, so we can answer them afterwards. And we try to start the conversation with those questions that were in the parking lot next session. Remember that we are getting together every Friday at 3 o'clock UK time. So next Friday, again, we invite you to participate. And the Friday afterwards, we're going to have practical cases with founders and so forth to walk you through the whole process of investing. If you're a founder, or if you're a VC, an investor, and you would like to invest, that's also more than welcome. So thank you so much, Josefina, for all your knowledge. It was very practical. In my case, I understood a lot that was in my mind before. So
that's great. Happy to hear, because legal stuff is not easy to explain sometimes. So
For sure, it's a complex subject, but you made it so easy to understand, at least for me, I'm pretty sure for the guys too, for the audience. So thank you so much on behalf of Cambridge, on behalf of Oxbridge Capital Partners and Genesis too. And we welcome you all to participate next Friday then at 3 o'clock. If you would like to have access to the PowerPoint, to the video, please send us the email because we are sharing knowledge. That's the purpose of these webinars. Thank you so much.
Thank you all, guys.
Thank you, Josefina. Thank you all.
Bye.
Bye-bye.